Hello, students. Welcome to the next lesson of entrepreneurship. We are in chapter 2, entrepreneurial planning. In the last lesson, we have already studied about the joint stock company. Today, we are going to learn about the types of joint stock company. So, based on the ownership, the companies can be classified into private company and public company. According to the Companies Act 2000, a private company is the one which has a minimum of 2 and maximum of 50 members, excluding the employees, which does not offer its share to the general public, which does not invite the general public to deposit or invest in the company, and which has a minimum paid up capital of rupees 1 lakh. And a public company is the one which has a minimum of 7 members and maximum no limit, which invites general public to invest in the shares of the company, and which has a minimum paid up capital of rupees 5 lakhs. Now, after knowing about the meaning, it is important for us to know that a private company has more benefits over the public company in the following ways. Number one, a private company can be formed with only 2 members, whereas at least 7 members are needed to form a public company. A private company must have at least 2 directors, whereas a public company must have minimum 3 directors. Number three, a private company can issue loan to its director without any permission of the government, whereas a public company must take permission of the government before giving loans to its directors. Number four, it is not necessary for a private company to issue a prospectus, whereas it is essential for a public company. And the last one is a private company can start its business only after getting the certificate of registration, whereas a public company can start its business only after receiving the certificate from the for the commencement of the business. Now we will learn about some of the important terms which are necessary for starting a company. The first one is PAN. The full form of PAN is Permanent Account Number. It is a 10-digit alphanumeric number issued by the Income Tax Department. Now, here alphanumeric means this number consists of alphabets and numbers as well. PAN is linked to the Income Tax Department with all the transactions of that person in the business. PAN acts as an identity of the person with the Income Tax Department. Now, the question is who must have a PAN? Number one, all persons who are required to furnish to the tax return. And number two, any person carrying on any business or profession whose sales turnover are likely to exceed 5 lakhs in any previous years. The next term is service tax. Now, service tax is a tax on service. It is levied on or charged on the services specified by central government. It is an indirect tax, that is, service provider pays the tax and recovers from the recipient of the service. Here, recipient means the one who is getting the service from the service provider. That means the service provider will pay tax to the government, and in return he will recover it, means he will get back the tax that he has paid from the one whom he is providing the service, that is the customers. Next is the excise duty. Excise duty is a tax on manufacturer or producer of goods. Duty means tax. Excise duty is collected by the state government as well as the central government. The excise duty on alcohol, alcoholic preparation, and narcotic substances is collected by the state government and is called the state excise duty, whereas excise duty on all other products is collected by the central government and is called the central excise duty.